Hello and welcome to the CMSL question paper analysis. In this session, we are going to discuss in detail the questions from the ICSI December 2024 question paper of CMSL. What are we going to do in this session? We are going to read the question from the question paper, identify the keywords, discuss the question, discuss the answer and refer to the suggested and the guideline answers prepared by us to see how you are required to present the answer in the answer paper. We have exclusively created a document for suggested answers or guideline answers. If you want access to that document, you can fill the link in the description below. You will get access to the document. We will send it across to you. Now, this session is going to be useful for whom? It is going to help two categories of students. First, if you have actually attempted this December 2024 attempt, it is going to be helpful for you to identify where you have gone wrong and what is the scope for improvement in the upcoming exams. And if you have not attempted this exam, you are attempting in the June 2025 attempt, it is going to help you understand how to interpret a question, how to read the question paper and how to present the answers in the answer paper. So, let's quickly begin the discussion on the CMSL question paper and discuss in detail. Now, first one, question 1A. Now, one more tip or trick that you should follow is, generally in case study type of question, the question is very lengthy, okay. So, instead of actually first going through the case study or hypothetical situation that they have given, first scroll through and go to the sub questions and read the questions and identify whether it is anywhere connected to the facts or hypothetical case study that they have given, because many a times the questions that are given in the sub questions can be answered even without reading the hypothetical case that has been provided in the question paper. Now, why do I say that? Because on the basis of the question, you are going to determine how much time you are going to spend on reading that hypothetical question. Two situations might arise. First one is where the questions are not connected to the facts. Just by reading the questions, you are having an answer to write. In that case, you are still going to read the hypothetical case, but very quickly. You are not going to spend a lot of time. You are not going to read the question in depth. You are just reading the facts to use that in the presentation of your answer. Second situation is where the question that has been asked in the question is directly related to the facts that have been provided in the question. So, you have to spend a lot of time and pay attention to detail to the hypothetical situation that has been asked in the question. So, this is the approach that you should follow for a long lengthy case study type of question. So, let us first read the sub questions that have been asked and then see how much of our time we are going to spend in reading the case study that has been provided. First sub question is, what will be the procedure followed by SEBI for withdrawal of a recognition at the stock exchange? Will the contracts entered by the stock exchange before the date of withdrawal of recognition be valid? Who are bound at the stock exchange to produce documents sought by SEBI? What are the provisions relating to the maintenance and preservation of books of accounts at the recognized stock exchange? And can the business of a recognized stock exchange be suspended? And each one of these 5 questions carry 2 marks each. If you see, each one of these questions is a direct question from the Securities Contract Regulation Act. Even without reading the case study, you can answer each one of these questions. So, we are going to not waste a lot of time in reading the case study type of question. We are going to quickly just glimpse through, because we want to understand the facts for the purpose of answer presentation. Okay, so, we will quickly go back to the question and read through that the stock exchange, once a vital financial hub, had lost its significance due to evolving financial market. It was established decades ago, initially served a broad spectrum of investors and businesses, but emergence of national level stock exchanges and technological advancement, this stock exchange struggled to keep pace with modern regulatory and operational standards. In the year 23-24, SEBI conducted the review of the stock exchange's operation to assess its adherence to the newly established regulations. The review revealed several deficiencies in the stock exchange's trading practices and compliance measures. When SEBI requested detailed information, the stock exchange failed to provide the response, demonstrating significant lapse in the management and operational framework. As a result, SEBI has decided to de-recognize the stock exchange, effectively preventing it from functioning as a stock exchange, and this decision highlighted the importance of compliance, technological adoption and transparency for the survival of regional stock exchanges in the competitive financial landscape. On the basis of the facts, you are required to answer the 5 questions. So, overall we have understood that it was a regional stock exchange. It did not keep up with the changing technological advancement and regulatory advancement and operational requirements. That is why over a year it has phased out and there were a lot of lapses in the management and documentation. It was unable to answer to the SEBI's queries. So, that is the facts. On the basis of those facts, we are required to answer these questions which has no relevance, but we are going to use the facts while we are presenting the answer. Now, firstly, what will be the procedures? Let us go to the guideline answers. Along with the presentation, we will discuss the answer. 2 things can be done at once. First one, answer 1A, what is the procedure to be followed by the stock exchange? By SEBI for withdrawing the recognition of a stock exchange. Here the procedure to be followed by SEBI. So, again whenever you are writing any answer, make sure that firstly your question number is correctly written. Whenever you are answering multiple sub-questions of the same question, ensure the number of sub-question is correct and provide suitable headings. Okay, heading is very important to have a neat answer paper. So, we are going to start with the heading saying the procedure to be followed by SEBI when it is going to withdraw the recognition from a stock exchange. The answer is clear. It is section 5 of the Secretaries Contract Regulation Act, where powers have been given to SEBI to withdraw the recognition of a stock exchange if it is required in the interest of the trade and in the public interest. But basic protocol is there. First, you should send them a notice, written notice to the stock exchange telling them that you are planning to withdraw the recognition for certain reasons. What are the reasons because of which you think that the recognition should be withdrawn, and give an opportunity to the governing body of the stock exchange to give you a reply of why you should not withdraw the recognition. If SEBI, after hearing the party and after all the basic inquiry and investigation, if they are still thinking that it is better to withdraw the recognition, they are going to pass the order of withdrawing the recognition through a notification in the official gazette. So, this should be your answer. As far as possible, write your answer point wise. Mention the section or the provision initially if you know it correctly. If you don't know the section number, if you don't know the regulation number, avoid it, but mention the name of the enactment, mention the name of the regulation. So, the answer is very clear that it is SEBI can send a notice along with the reasons why it is withdrawing. After hearing the party, if it is still not satisfied, it is passing an order of withdrawal by publishing it in the official gazette. That is the procedure for withdrawal of recognition. Second question was, what is the status of contract that has been entered before the order of withdrawal has been passed? Again, it is something that has been done in the past, so I don't think it is going to impact the validity. So, all the contracts that are executed before the date of withdrawal are going to continue to be valid. Till those contracts are fulfilled, we are going to give the timeline for the stock exchange to fulfill or execute whatever is pending. So, that is provided again under section 5 of the act itself, where it is clearly been provided that the withdrawal of the recognition will not affect the validity of the contracts which are made before the withdrawal notification. If you are executing a contract after the withdrawal notification, that is not going to be valid, because you know that from so and so date your recognition has been withdrawn. Whatever has been prior, only that is going to be valid. And for that reasons, we are going to give some time so that you ensure that all your existing commitments are properly fulfilled, right? On the basis of this is very important for the presentation aspect, that on the basis of the above mentioned provision, the contracts entered into by the stock exchange, mention the name that is provided in the question paper to give a personal touch to your answers. So, here the contracts entered into by the stock exchange before the date of withdrawal are going to be valid. Give a conclusion of what can happen in the instant case. Third sub question is, who is the person responsible at ORASIS to produce the documents sought by SEBI? Again, it is a direct question where we know that whenever any inquiry, investigation or anything is being conducted by SEBI, every person associated with the stock exchange, every employee, every clerk, every director, every person, everybody will come under the obligation of complying and coordinating with the investigation procedure. So yes, any person who is the director, manager, secretary, any officers, any member of the stock exchange, if a member is a firm, all the partners or the managers of that firm, any person or people who are involved or for the transactions on the stock exchange, all of these people are going to be responsible for providing the documents. Again, they have twofold responsibility. First, their responsibility is to provide relevant books of accounts as may be asked by SEBI, and thereafter if they ask for any other information of document, submitting that document statements also become the responsibility of the people who are employed by stock exchange. Fourth sub-question was, what are the provisions with respect to maintenance and preservation of the books and other documents of a recognized stock exchange? Again, any document is required to be preserved for a period of 5 years as prescribed according to the central government, and at any point in time it is allowed to be inspected by SEBI as may be required. So this is the provision for maintenance. And last question is whether the business of a stock exchange can be suspended or not. The answer is under section 12 of the Secretaries Contract Regulation Act, where yes, the business of a stock exchange can be suspended only in case of an emergency, and that should be in the interest of the public and the interest of the trade. And you can suspend it initially for a duration of 7 days by giving them a notice. Second one, if any reason you are not able to finish whatever the suspension order for 7 days is not enough, you want an extension, you can extend the suspension of the business of a stock exchange for further period, but again a notice should be sent and opportunity of being heard should be given before extending the order of suspension. That is the provision that you have to write. So as of now, see what is the presentation. Clearly you mention what is the question number, under that what is the sub-question, clearly give a headline, clearly give a heading to that particular sub-question. Sub-question 1, sub-question 2, sub-question 3, sub-question 4 and 5. So clearly have a very neatly organized answer paper, and since it is for 2 marks, directly answering what has been asked is sufficient. You don't have to give introduction, conclusion, all that is not necessary. Answer to the point, don't waste a lot of time in answering 2 marks question. Next, let's get to question 1B. Let's read the question and then see what should be the answer. Okay. Like I told you, first let's read through the sub-questions. How many directors should be liable to retire by rotation at the annual general meeting? Again, it is something that we should read the question too, because they would have given the board composition in the question, and we should tell how many directors are liable to retire. What is the upper age limit for an appointment or continuation of a non-executive director without the approval of the shareholders? What is the maximum limit of independent directorship for a managing director in a listed company? What is the type of instrument under which non-profit organization can raise fund? And if a director of a listed entity has vacated his office for medical reasons, advise how his vacancy should be filed. And each one of these 5 questions again carry 2 marks each. So yes, here somewhere relevance is there with the question 2, 3, 4 and 5 you can answer even without reading as such, but for question number 1 maybe they have given the board composition for which we have to read through the question in detail. So let's quickly read through the question and identify what are the facts of the given situation. First one. MCOM Limited is one of the leaders of e-commerce business. Its board has a strength of 12 directors, excluding 3 nominee directors who are not liable to retire by rotation and 4 independent directors. So in this 12 directors, they have already excluded the nominee directors and the independent directors. Totally it is 12 plus 3 plus 4. but they have given us these details. Now, the company had completed first round of fundraising 2 years back. So, it is a public company, but it is not public listed company. It is an unlisted public company as of now. Okay. One of the conditions of the shareholders agreement was to list the securities in the near future. That means they are going to plan the initial public offer in future. To tap the opportunity of growing stock market, it is planning to list itself on the stock exchange platform so that its existing anchor investors are able to sell off their holdings. The company secretary has advised for changes in the composition of the directors as per SEBI regulations. Okay, so what are they telling? They are talking about this is the existing board structure, but because the company is going to become a listed entity now, certain compliance requirements are different. So, the company secretary has advised that you please make changes in your board composition to satisfy the SEBI regulations. Here, which regulations will be applicable? SEBI LODR regulations will be applicable, where we are going to talk about the corporate governance aspects, the board structure, committee structure, the maximum number of directorship. All those provisions come under LODR regulations. So, we are going to solve this entire problem on the basis of LODR regulations. Again, LODR regulations come from part B, but they have asked this question under part A. So, let us read further what has been provided. They have given still further more facts have been given. Nirvan is a non-executive director having in-depth experience. He will be attaining the age of 65 years once the listing procedure is completed. After listing, the managing director serving as an independent director in 2 more listed entities and 1 unlisted company is expected to receive more offers for being appointed as an independent director in 3 more listed entities. So, this is with respect to age limit question. This is in relation to the number of directorship question. Okay. The promoters are actively engaged in various philanthropic activities. They are promoters of Save Tree Foundation, a Section 8 company working for the livelihood generation amongst underprivileged community. They have learned now that non-profit organization can also raise fund through the open market. So, this is for the next sub question about how a Section 8 company can raise funds from the stock exchange. You have to answer that. Now, after analyzing these facts, answer the following question. So, let us quickly discuss how many directors should retire. Again, it is a provision of Companies Act that is going to be applicable. 2/3 of the total strength of directors, excluding the people who are not liable for rotation and the independent directors. Excluding this, how many are there? 2/3 of those should be liable for rotation. Out of that, 1/3 will actually retire. So, we are going to calculate that and mention the actual number of directors that are going to retire on the basis of the board structure that they had given earlier. What is the upper age limit for appointment to continue as a non-executive director without the approval of shareholders? It is 75. Up to 75, we don't need the shareholders' approval for continuation. The non-executive director can continue, but even after 75 years of age, you want that director to continue as a non-executive director, we need a separate approval. Special resolution is required to be passed at the shareholders' meeting. So, that the age limit will become 75. Till 75, you don't require approval. Here in this case, his age was 65. So, again, here you don't require an approval. What is the maximum limit of independent directorship for a managing director of a listed company? So, if you are a whole-time managing director of one listed company, there is a restriction that you cannot be an independent director in more than 3 other listed companies. So, here the managing director was already an independent director in 2 listed companies and 1 unlisted company. He is getting offers from 3 more companies. So, that is going to cross the threshold. He cannot accept all the offers. He can accept any one company's offer of becoming an independent director. What is the type of instrument under which a not-profit organization can raise funds through the open market? Again, it is zero principal, zero interest, that bond, zero coupon, zero principal amount bonds that can be issued for raising funds through the social stock exchange. If a director of a listed entity has vacated his office for medical reasons, please specify. Again, within 3 months period, you have to appoint somebody in place of that person. So, again, all direct questions you can answer. Only for the first one specifically, you had to read the question. For all others, you can answer even without reading the case study, but because they have given one point or one fact for each one of these questions, it is important for us for presentation of answers. Let's quickly look at how we are going to present the answer for question 1B. First, again, like I told, please keep your headings clear. First one is, what is the number of directors that are liable to retire by rotation at the annual general meeting? It is the provision of the Companies Act, section 152, subsection 6 talks about it. Mention the provision, what are the points, and then provide the connection with the facts. Say that in the instant case, Ecom Limited has 12 directors excluding 4 nominee directors, 4 independent directors and 3 nominee directors. So 2/3 of 12 will become 8 and 1/3 of 8 will become 3. So people who are liable to retire by rotation is 8, people who are actually going to retire are 3. And the same people can be reappointed, that can also be mentioned. Second sub-question was, what is the upper age limit for being appointed as a non-executive director? Age limit is 75. If after 75 you want to continue as non-executive director, approval of the shareholders is going to be required. So please mention the law, and then in the last give one statement that in the instant case, Nirvan can continue to be a non-executive director without the approval of shareholders because his age is just 65 and not 75. Next, what is the maximum limit of independent directorship for managing director? Like I told you, not more than 3 listed companies he can be an independent director, but in the instant case he is already an managing director of Ecom Limited. He has independent director of 3 companies, 2 unlisted companies, 2 listed companies, 1 unlisted company, and offers from 3 other listed companies. So keeping the provision in mind, you can give a conclusion that based on the facts and the provision of law, he can accept only 1 of the 3 other offers that he is given, because maximum limit is 3 independent directorship in listed entities. So that is going to be the answer. Next, what kind of instrument can be issued by a Section 8 company for raising funds? It is the zero coupon, zero principal instrument, which is going to be issued on the social stock exchange. Mention these provisions from the relevant act and mention that yes, they can, that is the Save Tree Foundation. So wherever names have been given, try to inculcate those names in your answer. So the Save Tree Foundation can raise money through the stock exchange, that is social stock exchange, by issuing the zero principal or zero coupon, zero principal instrument. Next, filling of vacancy as a director. Again, whether it is medical ground or otherwise does not matter. Within 3 months, we should fill the vacancy as may be required. So that is the provision for question 1A. Now let's go to the question paper for the next question. If you all want this document of the suggested answers, please don't forget to fill the Google form provided below. You will get an email with the document. Now let's move to the second question. Question 2A. Again, here you have an option, question 2 or 2A. How are you going to identify which one you should attempt? Whichever questions you know better, whichever questions you are able to answer, you please select that question. If you have a confusion that in one I know 3 questions, in one I know 2 questions, please go for the question that you know maximum and better. Answer it like that. Now, let's read question 2A. A retail investor, Rajesh, has invested in a mutual fund scheme, but he noticed irregularities in the fund's performance and management. Despite multiple attempts to resolve the issue with the mutual fund company, he has received no satisfactory response. Rajesh has decided to approach SEBI complaint redressal system for assistance. In the light of this, answer the following questions. So what is it? The entire question is based on the SEBI Act scores mechanism, where they have said that Rajesh is an investor who is invested in a mutual fund scheme, but he was not happy with the performance of the fund. He has tried to reach out to the mutual fund company, but they are not resolving his solution. He is not resolving the problem that he is facing. So he has decided that he is going to approach scores mechanism. First one, how should he file a complaint? How? He is going to go to the scores mechanism platform, register himself, provide the details, submit the complaint that he has. What information is he required to provide? Two categories of information are there. First is personal information. What is his name? What is his capacity? Retail individual investors. What is his PAN number? What is his basic demat account number? Basic things to prove that he is an investor in the market. Second one is the details with respect to the problem that he is facing, against whom he wants to file a complaint, what is the nature of complaint, has he used the direct mechanism to first approach the company, if he has approached the company, when did he approach the company, did he get a reply, did he not get a reply, he got a reply but he is not satisfied with the reply. All these details are required to be submitted along with the necessary documents you can attach. That is the information required to be provided. What is the timeline for lodging a complaint and one-time review option? Again, within 1 year of the cause of action, you are required to raise a complaint. If 1 year period is elapsed, this course mechanism will not permit you to file a complaint. One-time review option is after you get a satisfaction, after your complaint has been resolved in scores mechanism, you are going to have 15 days timeline. If you are not happy with the resolution provided even on the scores mechanism, within 15 days of getting a reply, you can apply for review of the answer or solution provided on the scores mechanism. Can a complaint in scores be filed against a company under liquidation? If yes, state the procedure. The answer is no, you cannot. So, you are going to mention the companies against which you cannot lodge a complaint on the scores mechanism. So, there is no procedure, but there is a list of companies against whom we cannot file a complaint. So, again it is a very simple and direct question. Please note that first 3 questions are for 1 mark and the fourth question it carries 2 marks, total 5 marks. Let us quickly see the answer, how we are going to present this answer. Okay. So, first one was, how can he file a complaint? Basic thing is he has to go to the scores mechanism, scores website, click on register here, investor corner, he is going to create a profile for himself, then he is going to give his personal details, permanent account number, name of the details, KYC, Aadhaar, okay, all that, and he is going to submit and create his profile. Once his user ID and registration is done, he can file a complaint by giving the actual details and click on the submit button. That is how he is going to file a complaint on the scores mechanism. Again, because it is a guideline, there is no provision, no section number, no regulation number, it is just a notification of SEBI. So, you can just directly mention whatever is the problem. But you can file a complaint on the scores mechanism only by taking a direct approach. First, you should approach the person who is creating the problem. If you don't get a reply, if you don't get a satisfactory reply, or you don't get a reply at all, okay, in that case only you are going to file a complaint on the scores mechanism. Second sub question is, what is the information required to be provided by Rajesh? So, in the question only, in the heading only you can mention the information to be provided by Rajesh to file a complaint on scores mechanism. Okay, so Rajesh should provide the following information: personal data, details relating to the complaint. Personal data is name of the investor, PAN, contact, Aadhaar, KYC, and details relating to issue or complaint is what is the complaint, when the cause of action arose, whether you filed a direct approach, what is the basic things. Okay, that is what is required to be given. Next, what is the timeline? Again, the timeline for lodging complaint is within 1 year from the date of cause of action from various dates. If you have received a answer from the person who is causing a problem, from the date you got a reply from them, from that date it is going to count. If you have not got a reply at all, okay, on that basis we are going to take 1 year period into consideration. And in the same question, 2 things they have asked. One is timeline for filing a complaint, and second one is timeline for one-time review option. For one-time review option, it is 15 days from the date you get the solution on the scores mechanism. Okay. Next, complaint on scores mechanism against a company under liquidation is not possible. So, there are certain list of companies against which you cannot file a complaint on scores mechanism. So, mention that a complaint cannot be filed on scores mechanism against a company which is under liquidation, and then justify that. Because it is for 2 marks, you have to give a justification of why you are saying, because in the notification itself SEBI has given a list of companies against which complaint will not be accepted. right? So give the list that if it is an unlisted company, delisted company, stuck off company, companies under liquidation, companies under IBC mechanism, the complaint falls under any other regulatory authority like IRDA, PFRDA, CCI, right? If it is against liquidated companies, again all these companies, the complaints are not going to be accepted, so write it. So again, even under question 2A, all the questions are direct, lot of interpretation is not required as of now to the questions that we have covered. So this was the last question. Now let's go to the next question, question 2B. What are credit rating agencies? What is the minimum net worth requirement for a credit rating agency? Explain in brief the general obligations of a credit rating agency. This is a question from the chapter Capital Market Intermediaries, and this entire question is for 5 marks, okay? No subclassification. So it is a descriptive answer. Till now what I would tell above is practical. Just have to give one line answer or one paragraph explanation sufficient. But this is the first descriptive question that they have asked, direct theory question that they have asked about credit rating agencies. So how are we going to structure the answer? First tell them what is a credit rating agency, put a heading, meaning of credit rating agency or what is a credit rating agency, give an explanation, then put what is the minimum net worth requirement, give an answer, then put what are the general obligation, and lastly give a valid conclusion because it is for 5 marks, so you should have a proper structure to the answer. Let's quickly go through the guideline answers or the suggested answers. First one, see, I have done the same. I have told, put in heading what is a credit rating agency, give the details. It is an authority that rates the business of securities, gives them a rating, what is the capacity to pay back, right? Credit rating, how it plays an important role, you can give those details. You can tell under which regulation they are governed. They are governed under SEBI Credit Rating Agency regulations of 1999, and according to these regulations, the minimum net worth requirement is 25 crore rupees. Then last question was, what are the general obligations of the credit rating agencies? Again, it is a direct question. I am not teaching here, so I am not going to go into the details. You just have to write the general obligations provided with respect to the code of conduct, preservation of books of accounts, what are the obligation towards the ratings, how they are going to provide the rating, what are the disclosures that they are required to make. All those are the code of conduct that you have to mention, okay? Basic general obligations of the credit rating agencies. Again, it is a direct question, nothing to worry about. Directly, if you have studied that chapter, you will be in a position to answer. Next question, question 2C. Every time should I scroll? Okay, fine, let's see. Question 2C. Buying a single share of any company is much riskier as compared to buying an exchange traded fund. Explain the statement with the reference to understanding about ETF. So what is your question? Your question is resolving around the concept of ETF, that is one of the various instruments in the market, right? So that is from your basics of capital market chapter, where you're talking about various instruments in the market. They've said that they have given a statement. They ask you to not justify the statement itself. They want you to give an explanation for that statement, talking majorly about what is ETF. So you tell them first what is exchange traded fund, what are the features basic of ETF, how does ETF operate, and how ETF operate itself is the answer of how it is safer than single investment, right? You're going to say that ETFs are functioning on the basis of an index, right? They have a benchmark index against which they are going to do the comparison and they are going to make an investment. So that is why exchange traded funds are safer, because it is diversified, it is based on an index, it is based on a benchmark, right? So for these reasons, it is safer than any other single investment that is going to be made. So let's quickly look at the guideline answers of exchange traded fund. Again, give an exchange traded fund, give the statement, they say that the statement is correct, justify that whatever has been provided is correct, we agree to the statement that has been provided for so and so reason. Tell them what is the exchange traded fund, give them an explanation of how does the fund operate. On the basis of that, derive the key features, that there is diversification, it is having lower risk, it is cost efficient, and then give it is safe. Why is it safe? Because diversification is there, volatility will reduce, it is functional on the basis of index tracking, and sector specific ETFs are there that will reduce the risk. For these reasons, you can say that it is better and less riskier and safer way of investment when compared to direct single investment. So that is the conclusion. Next. Next question, again it is a direct question for 5 marks. Distinguish between currency derivative and commodity derivative. How are you going to write the answer? In one liner, first tell them what is a derivative, then say there are various kinds of derivatives. Now we are going to talk about two derivatives, one is commodity derivative, one is currency derivative. If you want, you can answer in paragraph wise, or if you want, you can draw a table and give the distinguishing factors between commodity and currency derivatives. So it is a direct theory question. Again, lot of interpretation is not required. So let's quickly read through the answer. Again, it is your choice how you want to present it. If you are going to present it in the form of a table, it is easier for the evaluator to know whether you know the concept properly or not, right? So give them basics first, give an explanation of what is a derivative and what are the two kinds of derivatives. Okay, if you want, you can give a one-line explanation, or you can directly go to the difference between and put it in the tabular form and explain. So what is the underlying asset? That is the main distinguishing factor. Here it is currency, there it is commodity. Here if it is currency, give them, it can be US dollars, it can be pounds, it can be euros, right? In case of commodities, it can be any kind of metal, it can be any kind of agricultural product like oil, okay, silver, crude oil, whatever. What is the purpose? Purpose for both of them is same, it is hedging, but here we are going to hedge against the currency fluctuation. Here we are going to hedge against the price fluctuation of the commodities. Participants, again here it is importers and exporters who are going to majorly be impacted because they are going to make the payment in foreign currency. So the currency value plays a very significant role. In case of commodity derivative, it is majorly people who are the producers, consumers or traders who are going to buy. Price influencing factors, again it is geopolitical because it is global, things are going to impact the currency fluctuation. Here commodity derivative along with the global, even supply demand mechanism is going to have an impact. Regulatory authority, both SEBI. Hedging application, again it is for against currency exchange traded, it is for price volatility in the commodity derivatives. So these are some of the differences that you can mention in the tabular format. Again, one more difference is currency derivatives, whether we are actually buying the currency after that or not, or we are only hedging the risk. Whether it functions in the spot market, future market and options, that is also a point that you can mention as the difference. Next. So that is question 2, which was easy. All the questions were direct, there was no complication. You could have easily answered question 2. Now let's look at the alternative question, question 2A. Okay, so let's see and read through the question. First one is that Green Tech Solution is a startup. It develops eco-friendly energy storage systems. It was founded in 2022. Its promoters are focused on products relating to sustainable technology to reduce the carbon footprints in the urban areas, seeking to revolutionize the green energy. This company wants to list itself on the IFSC. Considering these facts, state the criteria for listing the startup companies on the recognized stock exchange in the international financial service centers, and state the salient features related to direct listing and minimum subscription. So again, it is a question from chapter number 7, that is international financial service centers. It is a direct question, nothing to do with the facts that has been provided. Directly you can answer what is the criteria for listing of a startup and what are the provisions for direct listing and minimum subscription for it to become a successful IPO. Okay, so let's quickly look at the solution, how we are going to structure. Again, not much interpretation is there. It is a direct question that has been asked. Okay, direct. Yes. So please ensure you are writing the question number correctly when you are writing the answers. So I have given just the facts to give us that personal touch. The company now should keep in mind the following when it is going to list itself on the stock exchange in the International Financial Service Center. Give the criteria for listing. What is the criteria? Less than 10 years from the date of incorporation, because it wants to recognize or list itself as a startup company. So what is the thing? Less than 10 years from incorporation, turnover requirement should not be more than USD 20 million. The company is working towards innovation, etc., to be classified as a startup. If these criteria are fulfilled, then it can get a recognition as a startup on the stock exchange under the International Financial Service Center. Next is salient features related to direct listing and minimum subscription. Provisions, you can write direct listing, when it can do, what are the provisions. Offer size, what should it be? It should not be less than USD 2 million. Minimum subscription should be at least 50, and at least 75 of the offer size should be subscribed. Minimum number of people who should make an application and get the shares is 50, and at least 75% of your entire offer size should be subscribed to. These are the provisions under the International Financial Service Center's regulations. Let's move to the next question. Question 2A, sub-question 2. Okay, what are the provisions? You have been newly appointed as a SEBI consultant for Techno AVR Limited. This is a fintech startup company incorporated in 2010 under the Companies Act 1956. Their management is seeking to list their company now on the BSE SME Emerge. So please advise the following. So you are required to advise the Techno AVR Limited as a SEBI consultant. So advice is sought because you are the company secretary. Can Techno AVR Limited get listed on the BSE SME platform? What should be the tangible assets of Techno AVR for the listing? What should be the post-issue capital? Is it compulsory to facilitate trading in physical or demat form? The company has changed its promoters about 10 months before the date of filing with the BSE. Will it impact the listing? So again, all are direct questions that are asked. Okay, so let's quickly answer from the guideline answers. Okay, see, here the presentation of the answer is slightly different because they have asked you to advise as a company secretary to the management of the company. So as a SEBI consultant, they have asked you to advise. So you can write it in the way of a letter to the management of the company. What is the subject? We are going to give you details about listing on the BSE SME platform. So first concept that they asked you was listing of the company on the platform, whether it is possible or not based on the information, based on the requirement. So first requirement is it should be incorporated as a company under the provision of Companies Act. Whether that has been done or not, they said that it is registered under Companies Act 1956. Post issue capital should not be more than 25 crores. Net worth should be at least 1 crore for the 2-year preceding years. Net tangible assets should be 3 crores in the previous financial year, and there should be a good track record. All these are the eligibility criteria. If this is satisfied, the company can list itself on the BSE SME sector. Okay, what is it required? Tangible assets 3 crores in the preceding years. Post capital requirement should not be more than 25 crore rupees. Mode of facilitating trading, again it is because it is going to be listed on the stock exchange, mandatorily it should be in the demat form. Physical trading will not be permitted. Impact of change in promoters, there is a provision that at any point in time, if before 1 year of listing there is any kind of change in promoters, they are not going to permit the listing. In this 10 months before they have changed the promoter, so they have to wait for a couple of more months before making the listing application. If there is a change, we are not going to permit them to list. So let's wait for some time wait for 2-3 months more and then make an application for listing. You should tell, in this case, the promoters have been changed 10 months before the date of listing. So let them wait for 2 more months and then make an application for listing. Thank you. Regards, SEBI consultant. Okay, you can write it and present the answer in the form of a letter. Next question is question 2A, sub question 3. Does this change? Okay, again it is a case study type of question. Looks like we have to read in detail because they have given some kind of measures, but let's read through the sub questions. It is a 5-mark question carrying 2, 2 and 1 mark each. Is this 3 transaction constituting a bulk deal on stock exchange? So you have to read very carefully the facts because they have given some transactions and we should say whether it is a bulk deal or not. Second one is, what is the reporting time when a bulk deal happens through a single trade or a multiple trade? So you should give them what is the reporting time for a single trade transaction or a bulk deal happening through multiple transactions, and who is required to disclose these details to the stock exchange. So these 2 questions are direct questions. Okay. And the first question you have to read it. It is on the basis of the interpretation. It is from the secondary market chapter. So let's quickly read through the facts to see whether it is a bulk deal or not a bulk deal. Tech Global Corporation is a multi-technology company. It is decided to acquire a significant stake in promoting Indian startup Requisite Limited, but it is a listed company with the NSE. To avoid market disruption and potential price fluctuations, Techno Global and Requisite have negotiated and entered into a bulk deal. They only have told that they have entered into a bulk deal. So what is the first question? The answer is obviously yes. The transaction involves, so they have only answered the question in the question. In the question itself, they have given the answer to your sub question. The transaction involves the Tech Global purchasing 50% of Requisite's equity shares. This transaction includes shareholding held by one of its shareholder, Mr. X, as 5% and another shareholder, Mr. Y, as 0.5% of Requisite X total outstanding shares. A brokering firm, ABC Limited, facilitated this transaction. But once the deal was completed, ABC failed to report the details to the National Stock Exchange, where Requisite X shares are listed. Under these scenarios, answer the following questions. So yes, even for the sub questions, now we have got a context that why are they asking who is responsible to give the disclosure requirement. It is because this particular brokering firm has failed to give the disclosure. They are asking that particular question. So yes, in the question only we got an answer that it is a bulk deal. They have told it is a bulk deal. So what are we going to give as an answer? We are going to tell them what is a bulk deal. What kind of deals are called as bulk deal? We'll give them an explanation of what is the quantum that you should purchase to qualify as a bulk deal. Second one was reporting time, and last one was who should make the disclosure. Again, all direct question except the first one, but first one, for that the answer itself has been given already in the question. So first one, we should tell whether the transaction constitutes a bulk deal. Say that yes. First one, give them the details of what is a bulk deal. Bulk deal is a deal where in a particular trade, the total quantity bought or sold is more than 0.5% of the total number of equity shares of the listed company. In this case, they already told that the 2 companies have entered into a bulk transaction. So there is no second thought. You can say that yes, they have entered into bulk deal out of the 3 transactions. One is 50% of X's shareholding, one is 0.5% of Y's shareholding, and one more was one more transaction. So keeping all the 3 transactions in mind, you can say that yes, it was a bulk deal that has been executed here. Next, second one, reporting time. They have asked you reporting time for 2 things. If through one single trading activity, the bulk deal criteria is satisfied, what is the time when you should report? If not in one trade, but through series of transactions, you have executed a bulk deal, then what is the reporting time? So if you are entering into a bulk deal through a single trading window, you should give it immediately upon execution of that particular order. But if you are going to execute a bulk deal through multiple different transactions, then you are going to have 1 hour from the last trading where you are going to qualify as a bulk deal. After that last deal, within 1 hour, you have to inform that we have entered into bulk deal through series of transactions. Okay. In the instant case, there was a failure to report the execution of the bulk deal, hence it is going to become a non-compliance with the SEBI provisions. Last one was who has the responsibility of making the disclosure. Again, the responsibility lies on the stockbroker, and in the instant case, ABC Limited had failed to make a disclosure to the NSE. Here the stockbroker has to inform the stock exchange about the bulk deal transactions, but here ABC Limited was the stockbroker. They failed to give an information to the NSE, so there is non-compliance with respect to SEBI laws, rules, regulations, as well as the bylaws of the National Stock Exchange. Direct questions. Now, next question, sub-question 4, and the last one for question 2A to get over. List down the institutions which are recognized as qualified institutional buyers under SEBI ICDR regulations of 2018. Again, we are still studying part 1, and this is a question from participants of a capital market, which is a part of your basics of capital market, right? Again, direct question. They just want you to give the list of institutions. Basically, definition of who is a qualified institutional buyer, direct question they have asked. So, how are we going to address this particular answer? So, qualified institutional buyers, tell them who are they. They are the people who are going to buy the shares of company on a very large scale. They are considered as institutional investors, and they are huge participants in the capital market. There is, under the ICDR regulations, regulation 2 or sub-regulation 1 clause SS defines qualified institutional buyers. Give them the list of all the points who are considered as qualified institutional buyers. Since I am not teaching, I am not going to go into each one of the point. We are only going to discuss the answer. For this particular question, you have to mention the definition and list out all the kind of institutions that are considered as qualified institutional buyers. In the conclusion, you give them why QIBs are important for the capital market to function and how they play an important role, how the retail individual investors can route their investment through qualified institutional buyers, how it can help them. So, that was an end to part 1 of the question paper, which was relatively easy. Very few interpretation questions were there. Half of them were, more than half of them were direct questions that were asked by the institute. Now, let us move to part 2 of the syllabus and discuss the question paper from part B, which is more specific about the regulations. Again, question 3A is a mandatory question, no option, no choice. It's a direct 1 paragraph question, so we'll have to read through it. Rohit is a regular investor in the market. He is electronically holding 1000 equity shares with special voting rights of Growmore Limited. He made a request for rematerialization of his shares to the company. Rohit also wanted to know after how many days of rematerialization he can trade his shares. As a company secretary of Growmore Limited, explain the meaning of what is rematerialization, what is the procedure to be followed for rematerialization, and what is the tradability post remat. So, 3 sub-questions have been asked in the same question, and this question carries 5 marks. It is a direct question. This is from the chapter Depositories and Depository Participant. Though this chapter falls under part A, they have asked under part B. Okay, so let's see what is the answer. What is rematerialization? If you have demat shares, you are converting your demat shares back into physical form. That is a rematerialization. What is the procedure to be followed? Stepwise procedure is provided how you are going to actually give an application to the depository participant, okay, and then process it to the depository, going to the company and getting the physical share certificates and cancellation of your electronic share certificates in the demat form. What is the tradability post treatment? We all know that if you have shares in the physical form, it is not tradable, it is not even transferable. Earlier only trading was prohibited, but later with amendments they have said that even transfer of shares in physical form will not be accepted. Only for transmission we are going to accept physical share certificates, but for all other reasons, if you want to execute any trading activity, you have to again apply for dematerialization, get the demat shares and then execute the trade. So he wants to know after how many days of rematerialization he can trade. No, he cannot trade. He cannot trade at all. He again has to apply for dematerialization and then execute the trading activities. So this is the answer for this particular question. Let's see how we are going to present it in the answer paper. Again, since you are giving an advice to a shareholder as a company secretary of the company, you can structure it in the form of a letter. Say to Rohit, the shareholder of Gromor Limited. What is the subject? We are going to give him details regarding rematerialization of 1,000 equity shares that he carries in the company. Tell him, please find below the answer to all the queries that you have asked. First one, what is rematerialization? It is a process through which we are going to convert the electronic share certificates, demat shares, into physical form and issue a physical share certificate. You can give those details. Next. What is the procedure for rematerialization? Stepwise procedure is there. You should submit an application to depository participant. The depository participant is going to enter all the details about how many shares are there, which company, all the details in his database. That depository participant is going to inform the depository. The depository is going to inform the company. They are going to dispatch physical share certificates. Once the dispatch order is done, they are going to cancel the electronic share certificates, because one person cannot have demat shares and physical shares both. That will become double the holding. So they have to cancel the demat shares and only then issue the physical share certificates. Once the depository confirms that they have deleted the demat shares, then we are going to give them the physical share certificate. This is the process of rematerialization. Next, talking about transferability of rematerialized shares, we know it is not transferable. We know that it is not tradable also. So we will say that it cannot be traded after how many years? No, it can never be traded if it is in the remat form. You have to apply for dematerialization before again trading the shares. So the securities sent for rematerialization can never be traded. If you wish to trade your shares, you again have to apply for dematerialization. Physical shares will be accepted only at the time of transmission. Even at the time of transfer, it is not going to be accepted. Feel free to connect if you have any other further queries. Thank you. Regards, Company Secretary of Gromor Limited. This is how you should structure your answer. This is one of the ways in which you can approach and write the answer. Let's move to the next question. It is a mandatory question, no option. Question 3B. Okay. Gelwell Limited, a Bombay Stock Exchange listed company, has received a penalty order from the stock exchange for a default in compliance on 10th December 2024. Being the company secretary of Gelwell Limited, you have to decide the following situations. Can Gelwell Limited file an appeal against the penalty order issued by the BSE for the default in compliance? With whom and within how many days you are required to prefer an appeal? What is the time period within which the appeal should be disposed of? Again, direct theory question on the basis of appeal provisions, right? So here BSE has issued an order for non-compliance. BSE has the power, obviously, because there is non-compliance of the bylaws. They can give an application, they can give a penalty, they can also suspend them, the company. With whom we are going to appeal? We are going to appeal before the Securities Appellate Tribunal within the timeline, and they'll have certain number of days to dispose of the case. Let's see how we are going to structure this answer. The Securities Contract Regulation Act, read with the rules, will become applicable in the instant case for provisions relating to appeal. First one, in the instant case of Gelwell Limited, we should tell whether the appeal can be filed or not filed. Yes, appeal can be filed before the Securities Appellate Tribunal on the basis of the provision that if any person is aggrieved by any decision of the recognized stock exchange or the adjudicating officer, they have a right to appeal before the Securities Appellate Tribunal based on these provision, that is section 23L of the Securities Contract Regulation Act. On the basis of that provision, they have a provision of making an appeal against the penalty order issued by the Bombay Stock Exchange. Next is, what is the time period for filing an appeal? It is 45 days from the day when they receive the copy of the adjudicating officer or of the Bombay Stock Exchange. From that day, 45 days time they have to file an appeal. If within 45 days they are not able to file an appeal for any sufficient cause, the period can be extended by the Securities Appellate Tribunal for reasons to be recorded in writing. So, in the instant case, you can also give them the dates, because they said that penalty order was received on 10th December 2024. They have 45 days time starting. So, you can tell them they have the last day to file an appeal before 24th January of 2025. You can clearly specify the date as well, because they have given the date of penalty order. They will expect you to give your due date within which the appeal should be filed before the Securities Appellate Tribunal. Last sub question is, what is the time period within which the Securities Appellate Tribunal should close the case? They are going to give you 6 months time within which you should solve the case and dispose of the appeal that has been filed by the listed company. So, again, all direct questions from the Securities Contract Regulation appeal provisions. Next. Next question, explain the guidelines issued by SEBI for returning of the draft of a document and resubmission relating to issue of capital and disclosure requirements. This is one of the questions from the amendments and supplement material that has been issued by the institute for the attempt. So, same thing what used to happen earlier, that if your draft prospectus is not approved, it takes a lot of time to again begin from scratch. So, they have said that at any point in time, if there is any deficiency in your offer document prospectus, we will not put it at end. We will allow you to resubmit it one time, make changes and apply for resubmission of the same document. So, those are the provisions that are issued. The guidelines are issued by SEBI under the ICDR regulations. Provisions are already provided for in the supplement material. I am not going to teach you all the concept, but the provision is again direct. Okay. Generally, what is the expectation? That the offer document should be in simple language, lot of visual representation, correct information, true information. At any point in time, if there is any kind of lacking information, we are going to send it back to you for resubmission. You can return, the SEBI is going to send it back to you and ask you to resubmit the draft offer document. For both these provisions have been provided. When you are resubmitting, again the fees is not required to be submitted. It is only resubmission. So, new fees is not going to be required. Timeline is there. Within the timelines, you should provide the necessary documents. So, that is all about resubmission of offer document and return of offer document. Let us move to the next question, that is question 4A. Yes. Again, 4 is also a mandatory question. There is no option. It is again a direct question. Differentiate between initial public offer and further public offer. Which entities are not entitled to make the initial public offer? Direct question from the ICDR regulations. Not at all tricky, very, very simple. You should give them first the difference between IPO, FPO, and then tell the entities which are not eligible for making an initial public offer. So, how are you going to present it? Present it in the form of a table for better understanding. What is the full form of IPO, FPO? IPO is initial public offer, FPO is follow on or further public offer. Who makes an IPO? It is an unlisted company for the first time raising money from the public at large is going to make an initial public offer. FPO is going to be made by a listed company which has already first done an IPO. These are subsequent rounds of raising money from the public. So, this is going to be done by an unlisted company, but whereas for FPO, a listed company is going to make an FPO, right? It is going to be made by an unlisted company, listed company. This is first time of raising money, that is subsequent raising money. IPO is for company entering into the market for the first time, FPO is for already listed entity. So, these are the basic points of difference between IPO and FPO. Now, entities that are not eligible for making an initial public offer, regulation 5, sub-regulation 1 of the ICDR regulations. I have not mentioned specifically, but please mention that it is of SEBI ICDR regulations 2018, where that clearly talks about entities which are not eligible for making an IPO. List is there. If you are a promoter, promoter group, director who is debarred from accessing the capital market, if you are the promoter or director of any other company which has been debarred from accessing the market, if you are a fraudulent borrower or willful defaulter, if you are a fugitive economic offender, or if you have any outstanding convertible securities, if any one of these factors are applicable to your company, you will not be permitted to making the initial public offer. But again, talking about ban or debarment from the market, if the ban has been removed, after the ban has been removed or period of suspension or period of debarment is over, then they can make an application. It is only during the period of debarment they cannot make an application for IPO. With respect to outstanding convertible securities, if it is for the ESOP pool, then it is not taken into consideration. Even if the ESOP pool is outstanding, there is no problem. It is not going to be considered as outstanding and they can go ahead and make the initial public offer. So these details specifically are required to be provided because it is a 5-mark question. You have to answer in detail. First one is who are all the entities which are not permitted to make the IPO. Then with respect to point A and point B, with respect to period of debarment, once the period of debarment is over, the company will be eligible for making an IPO. And last one, with respect to outstanding convertibles, if you have something for the ESOPs as outstanding, that will not be considered as outstanding. Even with that outstanding balance, you can make an initial public offer. So these are the points that you have to mention to score full marks, because it is a 5-mark question. In detail, specific answer has to be provided. Let's move to the next question. Question 4b, Zubin has been declared by a private bank as a willful defaulter under SEBI SAST regulations 2011, but he is still interested in acquiring shares of XYZ Limited. Explain the meaning of who is a willful defaulter. He is declared as a willful defaulter by a private bank. Therefore, discuss about the options that are available with Zubin to acquire XYZ Limited shares. So, who is a willful defaulter? You have a list as issued by the authorities, RBI, in consultation with SEBI, that so and so person is a willful defaulter. If your name is there under the name of a willful defaulter and you are on a board member, you cannot make an IPO. We have already seen that provision. But also, if you are a willful defaulter, there are a restriction on you acquiring shares under SAST regulations. Only you yourself cannot make an open offer. You can only make an investment through competing offers. That is the provision that they are expecting you to write from the SAST regulations. Again, it is for 5 marks. You have to write a detailed answer about who are willful defaulters, who are eligible for making the acquisition, and here, because he is a willful defaulter, what option he has if he wants to make the acquisition. Okay, these are the points that you have to write. Let's see. 4b, you have to first give a meaning of willful defaulter. SEBI SAST regulation has given a definition for willful defaulter. Write that definition. Right, regarding provisions for acquisition by a willful defaulter, they clearly say under regulation 20 that they only have an option of making an acquisition through a competing offer. So here, in conclusion, give an answer that Zubin, because he is declared as a willful defaulter, he can acquire the shares of XYZ Limited only and only through a competing offer. He cannot make an open offer, he cannot make a direct offer. Only if somebody is making an offer, he can compete it and issue a competing offer. That is the only one solution through which he can acquire the shares of XYZ Limited. Slightly interpretation based. Next, ABC Limited is an auto component. This is question 4c. ABC Limited is an auto component manufacturing company incorporated under the provisions of the Companies Act 2013. The company is listed on the BSE. The paid up capital is 400 crore rupees as per the latest audited balance sheet. The company fails to comply with the various requirements set out under the listing agreement. BSE listing agreement, it has not complied with the prescribed time limit. the stock exchange orders for compulsory delisting of the equity shares of ABC Limited. Being the company secretary of ABC Limited, you are required to advise regarding the public notice before delisting order and what are the rights of the public shareholders. So here the company is going to be delisted compulsorily by the stock exchange because they have not followed the bylaws, they have not followed the listing agreement. So stock exchange has said that we are compulsorily delisting you because of non-compliance. Now you are the company secretary and you have to talk about two things: public notice before delisting and rights of shareholders. What is public notice before delisting? That before delisting a public notice should be given in English newspaper, Hindi newspaper, regional newspaper. All these should have wide circulation about the delisting proposal of the stock exchange. That should be given before actually delisting procedure is carried out. What are the rights of public shareholders? Firstly, they have a right of getting a fair value for the shares. Second one, they have a right to actually get the timely payment. Okay, first they should get a payment and they should get it within the timeline that has been prescribed. Next one, they don't have a mandate that they should give their shares in the exit offer during delisting. It is their choice, it is their right to continue to be the shareholders and not accept the exit value, exit price or exit offer that is being given by the company. If they are okay to be the shareholders of the company even when the company becomes a delisted company, it is their choice. They can continue to be so. That is the right that they have, right to choice whether they want to continue to be the shareholders or they don't want to continue to be the shareholders. Those are the rights of the public shareholders. So let's quickly see through the guideline answers, how we are going to depict it. So provision relating to compulsory delisting by stock exchange, give them what is the meaning of compulsory delisting, who has the authority to do compulsory delisting, what are the provisions that are applicable, and notice requirement was there, no? So here you say that no order for compulsory delisting can be issued without following the guidelines that are given under the delisting regulations of 2021. First one was about public notice before delisting. Before passing an order of compulsory delisting, the stock exchange is required to give a notice in one English paper, Hindi newspaper, vernacular language where the registered office of the stock exchange is situated about its intention of delisting the company and giving 15 days of notice that if anybody has any problem of this company becoming delisted, you can please write to us and raise your queries before the stock exchange. You can call for any objections from the public. Notice should also be displayed on the trading platform. Rights of public shareholders, regulation 33 of the delisting regulations talk about the rights of shareholders. It is rights of the public shareholder for fair value. Whatever exit price is going to be decided, offer price is going to be decided, that should be fair value, it should not be undervalued. They have a right to receive the payment and receive the payment within the prescribed period of time. They have a right to choice, that they can retain the shares and not offer the shares in the exit offer, and they have a right to receive an interest for delayed payment. If the payment for the shares is not made within the timeline, for extended delayed days, they are entitled to receive the interest at 12%, 10% per annum. So these are the rights of shareholders. Let's move to the next question. Again, a repetition. If you have not still filled the Google form for getting this, if you want this document, you can fill in the form. Almost towards the end of the question paper, we only have two more questions, question 5 and question 6, but 6 has an option 6A. So typically 3 questions we have to finish. Again, question 5A is a mandatory question. There is no option. Money Plus Limited manages a mutual fund. The details of the mutual fund are as follows. We have given the value of investment, cash and equivalents that they hold, accrued income, short-term liabilities, long-term liabilities, accrued expenses, number of units that are outstanding. In addition to that, they have given us the details. X is holding 50,000 units of this mutual fund. He got an offer from Y to purchase his entire mutual fund holding at 110% of the net asset value. Determine the value of transaction that Y will pay to X. So it is a direct question based on net asset value from the mutual fund chapter. Here what have they asked you? They have asked you to determine the value of transaction that Y has to pay to X. What is the question here? X is actually the holder of the units in mutual fund. he has certain holdings, 50,000 units he holds, yes, out of the mutual fund. Now those 50,000 units of mutual fund have certain value. Okay, these are now going to be bought by Y, and he's saying that I'm going to pay 110% of the net asset value to you. So first we should determine what is the net asset value of these 50,000 units. Of that 110%, Y is going to agree to pay to X. So two calculations are required. First you should calculate what is net asset value. Second one, you should determine what amount Y should pay to X to take his 50,000 units in that mutual fund. So again, net asset value is a direct calculation, formula based. You just have to apply the values in the preset formula. 110% is the new variation of the question which we are going to discuss. Okay, so first, calculation of net asset value. Whenever you get a question on practical numbers, number based practical questions, I always suggest that write the given data according to your requirement. Don't go again back to the question paper to read it, because if it is there in your answer paper, it is easily applicable. You can directly apply it in the formula. Again, you don't have to read at the question paper. So write the given data. We have value of investment, cash equivalent, accrued income, short-term liability, long-term liability, accrued expenses, number of outstanding units. X holding is 50,000 units. Offer from Y is to purchase the entire 50,000 units at 110% of the net asset value. So now let's see the calculation of net asset value is a direct formula. Net asset value is the net asset of the scheme divided by outstanding units. But for the net asset of the scheme, you have a formula, that is market value of all your investment plus the receivable plus the accrued income plus the other assets minus the accrued expenses and other payables and other liabilities. So based on the data, the value of investment was 7.5 crores. We had cash 1.5, right? That is other income, other assets that comes under cash. You have no other income. You have accrued income for, so 0.23, so 7.5 plus 2.3 plus 1.5. All other things are expenses, short-term liability, long-term liability, accrued expenses. All this we are going to subtract, but please make sure that half of the values are in lakhs, half of the values are in crores. So you have to follow only one pattern, either write everything in lakhs or write everything in crores. You cannot miss out on the values, right? So 7.5 crores, 2.3 crores, 1.5 crore, minus 5 lakh, minus 1.2 crores, minus 10 lakhs. This is going to give you the net asset of the scheme. If you directly apply the formula and do the calculation, the net asset of the scheme comes up to rupees 9.95 crore rupees. Number of outstanding unit is 2 crore units. So applying the net asset value formula, it is the net asset of the scheme divided by outstanding units. So it comes up to 4.975 per unit. This is the net asset value of one unit. Now what do we have to calculate in the second thing? We want to calculate how much money Y should give to X to purchase his 50,000 units of the mutual fund. We know he has 50,000 units. 50,000 units into net asset value will give you the 100% of weightage of value of investment of Mr. X. But Y has agreed to give 110% of the net asset value. So what are we going to do? We are going to first say that X is holding 50,000 units. Offer from Y is to purchase the entire unit at 110%. So, and net asset value for one unit is 4.97 on the basis of previous calculation. So what are we going to do? We are going to multiply 50,000 units into value per unit. That is going to give you the 100% holding or 100% investment or net asset value of X's investment. Okay. Now, he is agreed to give 110%. So when 20, this is 100%. How much will be 110%? You have to simply cross multiply. So that is why we are going to do cross multiplication. If this is the value of investment, 50,000 into 4.975 is the actual value of holding of Mr. X. Y has agreed to pay 110%. So if this is 100%, what will become 110%? Cross multiply. So you're going to cross multiply and divide it by 100. So your actual value is Actual value of investment is 248,750, but why has to pay 273,625? Because he had agreed to pay 110% of NAV. Direct question is just cross multiplication that you have to do extra in addition to applying that particular formula. So this is the answer for this question. Next, let's go to the next question. Sun and Moon Limited is a Mumbai-based construction company. The company is listed on the National Stock Exchange. The balance sheet has been provided as below. Equity share capital is rupees 10 lakh of 25 rupees each, 12% preference share of rupees 2 lakh of 50 rupees each, Series A. 10.5 preference share capital, 10 lakh of rupees 100 each of Series B, 14% debenture of 4 lakh rupees 50 each. What is the maximum equity share capital that can be bought back, and what is the maximum number of equity shares that can be bought back? So it is from the SEBI buyback regulations. They want you to calculate on the basis of the given data. So we know the maximum quantum that can be bought back is 25% in one given year. Okay. So mention the provisions is under SEBI buyback regulations read with the Companies Act of 2013. The maximum limit of buyback, like I told you, is 25% or less of, very important, aggregate paid up capital plus free reserves of the company based on the financial statements. So based on this, we are going to consider two things. Maximum amount in 1 year cannot be more than 25%, and when you're buying back, your debt equity ratio at any point in time cannot be less than 2:1 ratio. So keeping these 2 points in mind, we are going to do the calculation. First one, they want us to calculate what is the maximum quantum of buyback that can be done. We know the maximum value is 25%, but based on the given data, based on the composition of the share capital or the capital structure of the company, let's decide what is the value that can be bought back. Equity capital is rupees 10 lakh, preference. So preference share is not anyways taken into consideration. We are only going to consider the equity capital. So we are going to take 25% of the equity capital, that is 25% of 10 lakh, that is 2,50,000 amount, rupees 2,50,000 can be bought back, and maximum number of shares that can be bought back. Here we know the value of one equity share was 25 rupees each. So if 2,50,000 can be bought back, what is the number of shares divided by 25? It will give you 10,000 shares. So 10,000 shares can be bought back. Direct question. Just the 25% concept you should take in mind and apply the logic. Next. Five C. Zenith Wealth Management is a leading investment company, collective investment management company dedicated to delivering exceptional financial services. It focuses on data-driven strategies and personalized solution. In the context of this, explain the provisions relating to collective investment management company with respect to maintaining proper books of accounts and records and dispatch of warrants and proceeds. Again, no interpretation, direct query question about the collective investment scheme. On that, you have to talk about maintaining of books of accounts by collective investment management company and how and when they should dispatch the warrants and the proceeds of any income. Let's quickly read through the answer. Again, we will specify the regulations that this is Zenith Wealth Management is going to be regulated by SEBI CIS regulations 1999. A lot of general obligations are cast upon the collective investment management company when they are going to deal with the company itself. We are going to talk only about the two general obligations that have been specifically asked. One is with respect to maintenance of the books of accounts. We know that all the collective investment management companies are required to keep and maintain proper books of accounts, documents, etc. for every scheme that they are going to launch, and be in a position to explain the transaction. For every scheme, the document should be separately maintained, and intimate to SEBI and the trustees the place where they are going to keep all these books of accounts, etc. so that any point in time any inspection is going to be required, they can go to the place that has been specified and mentioned by the collective investment management company. And with respect to preservation of books of accounts, they are required to preserve it for the 5 years period after the close of the collective investment scheme. Once the scheme is over, after that 5 years you should maintain, and after that you can dispose of the documents. Second point was with respect to dispatch of warrants. They are going to have you this period of 42 days for dispatch of warrants, and for redemption of the proceeds it is 30 days period. So again, directly you can answer because it is for a question. So that is it for question 5. Let's move to the last question, question 6, where we have to answer 2 questions, question 6 and question 6a, the optional question, one of which is write short notes on. So that is the protocol of the institute, that one of the question, that is generally question 6, is write a short note on for 3 marks. They are asked you writing a short note on asset management company, write a short note on frequently traded shares, write a short note on trust deed, and write a short note on code of conduct of mutual fund, write a short note on continual disclosures required to be made under the PIT regulations. So 5 short notes are required for 3 marks each. We'll cover all the short notes and then come back to the optional question on question 6a. So first let's see the answers to the short notes. First one, asset management company. This comes under the concept of mutual fund. Tell them what is the asset management company, what is the role, and how they are an important part for the functioning of the mutual fund. So tell it is one of the very important 5 constituents of the mutual fund. They are the people who are going to manage the funds of the mutual fund company. They are going to be appointed by the trustee, okay, or the sponsorer, as may be decided by the documentation. Okay, it is going to professionally manage the entire scheme. Tell them all the details, how it is going to be done. Next is frequently traded shares. It is under the SAST regulations with respect to how frequently the shares of that particular company are traded on the stock exchange. So it is regulation 2, sub-regulation 1J of the SAST regulations that defines a frequently traded share. So it means a share of a company which is traded turnover on any stock exchange in the previous 12 months preceding the calendar month in which the public announcement made is at least 10% of the total number of shares of that particular class of the target company. So if this many times the transactions are taking place, that means it is a frequently traded share. Okay. Next is trust deed. Again, whenever there is a instrument that is not equity share, something that involves a element of debt, something that involves a non-convertible security, then the entire institution is set up in the form of a trust, and whenever a trust is going to be created, a trust deed is required to be executed, and that is what they are testing here. They say that the issuer and the debenture trustee are required to execute the trust deed within the specified time as may be issued by SEBI. For different instruments, different timelines are there, so specifically not required. If they failure to execute the trust deed, it is a punishable offence under the provisions. What are the contents of the trust deed, what are the matters that you have to include, and what are the restrictions in the clauses of trust deed. At any point in time, you cannot waive off the responsibility or the what do we say, indemnity provisions. You cannot reduce your obligations and liabilities, and indemnity it cannot be given off by including a clause in the trust deed. So such clauses are prohibited under the trust deed. So if you mention these provisions with respect to trust deed, it is more than sufficient. I have given more only for 3 marks, I have written more, but if you put this, you are definitely going to get full 3 marks. Next is code of conduct on mutual fund. The mutual fund regulation talks about the code of conduct for the mutual fund. You can mention it that it should ensure proper dissemination of information, timely that information should be given. Excessive concentration of business with brokering firms should be avoided. They should have in-house people who are going to manage rather than relying on stock brokers. Scheme-wise segregation of books of accounts is required to be maintained, right? All these are the obligations, code of conduct that is required to be followed by the mutual funds. Last one is what are the continual disclosures required to be made under the PIT regulation. So again, what are PIT regulation is prohibition of insider trading. So anybody who is an insider and is executing the trading activities beyond a certain threshold, they have to give an intimation that we have executed so and so deal. So who are under an obligation? Every promoter, every member of the promoter group, every designated person and every director of the company. All these people are under an obligation to give an information if they are executing any transaction over and about 10 lakh rupees. Okay, within 2 trading days of executing the transaction, they have to give an intimation, whether it is through one transaction or through multiple transactions. They have to give an information within 2 trading days of touching the limit of 10 lakhs that we have executed these particular transactions. And the role of the company will be, the people who have executed the transactions are going to inform the company. The company will further inform the details about such trading activities to the stock exchange. So the person, director, key managerial personnel, promoter group, they are going to tell the company that we have bought or sold the shares of the company value 10 lakh rupees. Within 2 days of execution of the deal, they should inform the company. The company will further inform the stock exchange that in our company these transactions have taken place. That is a continual disclosure requirement under PIT regulations. Okay, so that is it with respect to write a short note under question 6. Now let's go to the last question, question 6A. Okay. What is the meaning of holding period return? Calculate the holding period return for a unit holder who has bought a unit at 24.60 rupees and received a dividend of 3 rupees, and the face value of the unit is 100 rupees, current price is 28.69 rupees. So two things are there. One is writing what is a holding period return, and second one, what is the calculation. Again, it is a direct formula based question, no interpretation, nothing. You just have to apply the values in the formula. You have to remember the formula to get it right. So we'll see how we are going to write the answer to this particular question. First, we'll give a side heading of what is a holding period return. It is the total return received from the holding of an asset or a portfolio of asset over a given period of time expressed in the value of a percentage. It is calculated on the basis of total returns and income, that is change in value. How much have you invested and how much money did you make out of it? Put together over a given period of time, how much have you earned through your investment? It is particularly useful for comparing returns between different periods. That is the definition. We have a direct formula. Holding period return is income plus end period value minus original value. Today, what is the value? And when you bought it, what was the value? This will show whether there is any increase in the investment that you have made. Any income that you have received plus what is the value of the asset, whether it has increased over the time, divided by original value into 100. This 100 is outside the bracket because we want to calculate in the way of a percentage. So it is not within the formula, but it is outside the formula because we want to take the value in terms of percentage. So what is the income? He has received the dividend income of 3 rupees. 3 rupees plus end of value minus original value. The current market price is 28.69. 2869 minus the original value. He had purchased it at 24.60. So that is the amount that he has invested from his pocket. Today the same value is 28 divided by original value, that is 24.60 at which he had purchased, into 100, that is outside the bracket. So it becomes 0.288 into 100, that becomes 28.82%. So direct application of the formula. Last two questions. PQR Limited is a pharmaceutical company, so it is question 6A, sub question 2. PQR Limited is a pharmaceutical company whose shares are listed on the BSE. The company management wishes to issue sweat equity shares in accordance with the provisions of Companies Act. As the Company Secretary of PQR Limited, you are required to advise the management of the company for the following things. What is the maximum quantum of sweat equity shares? What is the pricing of sweat equity shares? And what is the ceiling on managerial remuneration? Again, no relation. Facts, they have not given the what is the capital structure, etc. So all are the direct theory questions where they want to understand what is the maximum sweat equity shares that can be issued, what is the pricing at which sweat equity shares are going to be issued, and what is the ceiling on managerial remuneration. That means if a sweat equity share is going to be issued, will it be included under the managerial remuneration provided, or it is, can it exceed the limit? Should it be included in the calculation or not? These are the three things that you have to answer. Again, direct question. All you have to see is how you are going to present the answer. So because it is in the form of an advice, I have put it in the form of a letter to the board of directors or the management of PQR Limited. The subject is issue of sweat equity shares by the company listed on the BSE, that is the company that we are talking, PQR Limited. Maximum quantum of equity shares, because we know it is listed on the BSE, if you mention only these provisions, it's okay. You can skip the provisions relating to innovators growth platform, okay. But if you want, you can mention it, no problem. But since it is specifically talking about company listed on BSE, you can only include what is the maximum quantum that can be done for listed company on BSE. So if it is in one financial year, not more than 15% of the existing paid up equity capital of the company, overall limit for the percentage of paid up capital is not exceeding 25% of the paid up capital of the company at any given point in time. So in one financial year, not more than 15, overall forever, not more than 25% of the equity capital at the time, at any time. So that is the quantum. Next is pricing. Again, pricing, whatever pricing we apply under ICDR regulations, when we are making a preferential issue, same pricing mechanism will become applicable even for the sweat equity shares. You can mention that. And what is the ceiling on managerial remuneration? Again, the amount of sweat equity shares will be considered as a part of the managerial remuneration under Companies Act if the following two conditions are fulfilled. If the sweat equity shares are issued to any director or manager, then it is going to come under ceiling. Plus, it should satisfy one more condition. Only if both the conditions are satisfied, it is going to be included in the ceiling of managerial remuneration, or else it is going to be excluded. What is the second condition? That sweat equity shares that are issued to the directors or the managers, it should be for non-cash consideration. If it is for cash consideration, the treatment will be different. So if the sweat equity shares are issued for non-cash consideration, then only it is going to be as a part of managerial remuneration. If you have any further queries, you can connect with the company secretary of the company. This is what you should write. Coming to the last question, they have asked about the disclosure requirements under LODR regulations about after the board meeting, when and what disclosures are required to be made within 30 minutes of conclusion. Let's see the facts. ABC Limited is a newly formed manufacturing company by a prominent industrial house. Within 3 years of incorporation, as it has issued its first bonus share. Considering its overall performance, the share price of ABC Limited is transacted around 18 times in the Bombay Stock Exchange, but due to some difference with the management, the company secretary has vacated the office. So company secretary is not there. Looking at the past performance, ABC Limited has appointed you only as their new company secretary. Now you are the new company secretary. One of your junior company secretary has some kind of doubt. He's asking which outcome of the board meeting should be disclosed to the BSE within 30 minutes from closure of the meeting. Please explain. So what is a direct question? You have to give the list of transactions which are held in the board meeting, which have to be disclosed to the stock exchange immediately within 30 days of closing the board meeting. Direct question under the LODR regulations, that is disclosure requirements. A list is there, direct question. If you have studied the regulations, it is easier for you all to answer. I am not teaching, I am telling how you are going to answer, and we are discussing the question. So put a heading, disclosure to be made to the stock exchange within 30 minutes of closure of the board meeting. Again, I have not put it in the letter format because this is a conversation between a senior company secretary with a junior company secretary. So it's going to be just a verbal communication. It's not an advice as such. So we are not going to use any kind of letter format. Only mere heading is sufficient in this case. Disclosures to be made to the stock exchange within 30 minutes of conclusion of the board meeting. A long list is provided for under the provisions. You can mention those. For example, dividends, cash bonus, whether it is interim dividend or regular dividend, cancellation of any dividend along with reasons, decision of buyback, decision of further fundraising, decision of increasing the share capital through bonus issue, reissue of forfeited shares, okay, short particulars of any other alterations that you are going to make to the share capital, financial results, results of voluntary delisting of the company. For all these things, you have to, within 30 minutes of conclusion of the board meeting, give the outcome, whether it was board resolution was passed or board resolution was not passed. If it is passed, how many people approved, how many rejected. Entire details about the outcome of the meeting for that particular resolution is required to be submitted to the stock exchange. But if all these transactions are held on different days, for some reason in one board meeting you cannot complete the discussion, you are carrying out under multiple board meetings, then the last day, the day on which you have discussed that point, suppose 10 points are there, okay, out of the 10 points, 2 points require intimation to the stock exchange. One point is discussed on first day, second point is discussed on the second day. So how are you going to inform the resolution that is discussed in first day meeting? Within that day's meeting, 30 minutes, you should give an intimation. With respect to second resolution, on the second day when you have completed the discussion, 30 minutes after that meeting, you should give the disclosure. So the day in which you have held the meeting and discussed that particular resolution, in that meeting, 30 minutes after the meeting, you have to give the information. So this is what you have to write for the disclosure requirement. Again, you have not mentioned the regulation. You can clearly mention the regulation as per LODR provisions. So this was a complete in-depth discussion of the question paper CMSL December 2024 attempt. If you want this document, like I told you, you can fill the link in the description box and we will mail the copy of this document to you. Also, if you want any more help with respect to the CS course or any other material free supplements, you can also join our community. The link to join our Excel community is also provided in the description. If you have attempted this paper, don't worry, wait for the results. Let's see what is going to happen. If you want any help, you can also get in touch with us. And if you are students who are appearing in the June attempt, follow our page for more such content and tips and tricks of how you can do well in your exam. I hope this question paper analysis and discussion was useful.